Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, July 12th, 2018. As per request in the trading room, as well as just really catching up on the charts now that I'm back from vacation, I want to go over commodities. I was going to break it down into different types, but I think I'll bunch them all into here. It's not all inclusive, but mostly the commodities I either follow on a regular basis and or on a semi-regular basis. So that'll be gold, oil. We'll touch on gasoline maybe, and all the ag commodities, and a couple of the metals, industrial metals as well. All right, starting out here with gold. Let's see what stands out on this daily chart. Probably these overbought readings. Again, I talk about this often. If gold is in a bull market, remember this was a low back here, and I'm using GLD as a proxy here. It does track the price of gold very well. So there's the bottom back in December 16th, and one can say what you want, but it's hard to argue that gold is in an uptrend. An uptrend is simply defined as prices making a series of lower lows, which so far it has. Challenging this one, but we're still well off this low. It's not a perfect uptrend. So again, price is making a series of lower lows and lower highs, and so gold may be doing that. Although I can't really say it's pushing the limits of that yet. I could see it possibly going all the way down here to 114. You have a couple reactions there, but again, bigger picture, strip all those trend lines and annotations away, and that's what it looks like. So where I'm going with this is, so under that assumption that gold is in an uptrend, a new bull market off the 2016 lows. As I often say, you can use the RSI for a couple. Uh, I find some value in the RSI for two reasons. Number one is that during a bear market, remember again, this was the end of the bear market, so you can call that the beginning of the bull. This last slide down was that last capitulation sell-off, what they call puking up gold. All the longs that finally give up, throwing the towel. So this is bear market, the end of the bear market. Doesn't show here. You have to go to the left of the chart. And where I'm going with this is, as I often say, oversold during a bear trend tends to become more oversold, meaning well below that 30 level, which is considered, that blue line there is 30 on the RSI. So you tend to become more oversold, meaning well below 30, and stay oversold for an extended period of time. Whereas in a bull market, oversold readings are usually fleeting, usually one and done. You hit that 30 level, maybe even reverse a little shy, maybe get a little below it here. This was, again, I will admit, deepest oversold reading we've had, but so far we're back above there now. So this is sort of, I don't call it do or die time. Anything's possible. Gold doesn't have to be in a bull market, doesn't have to be in a bear market, it can be in a deer market, which is a sideways trading range. So we'll see what happens. But I do want to make mention there. There it is, deeply oversold. And if you stepped in the last few times, or actually every time in the last several years, at least the last 2 years, that gold was oversold and bought, you would have done very well. You would have bought and been able to get in for a nice trend trade, make money. And of course, if you use the miners, you get more bang for your buck. So there it is. So that's the glass half full scenario, that if gold is in a bull market, and this is just a big correction within that bull market, this is a great buying opportunity, or will soon prove to be. And then again, like I say, in a bull trend, overbought, just like oversold tends to become oversold, more oversold, or stay oversold for an extended period of time. You tend to get that with overbought in a bull market, where overbought readings are persistent. Stay overbought for a while, and so far that's been the trait for gold since it bottomed back here in 2016. So, is this bull run over? Possible. We'll see, but take it for what it's worth. And then the other thing, more importantly, we look at a weekly time frame, and here's the thing: gold is at support. This is a long-term trend line. This is the uptrend line off that late December 15 low right there. You see a few reactions there, second reaction there, and now we're dancing on that level in the last few weeks. So we have a third reaction. If gold reverses off this level, that'll help to validate this trend line. That'll be our third tag. Since the trend line, I'm not talking each individual candle, I'm talking clusters, like tag 1, tag 2, tag 3, which helps to validate it. So then you have the bigger picture. Here's the downtrend line. This was the last bull market high back in 2011, and this forms a symmetrical triangle. So gold's coiling one way or another. Hard to argue whether you're bullish or bearish on gold, that it's coiling and approaching the apex of this symmetrical triangle pattern, these two trend lines, as well as really trading, for the most part, It's traded a lot in this range. It's had a couple moves below it, but you can see here these two horizontal lines around 130 and down around the bottom around 115. Again, it's dropped below there a couple times, but it's yet to break above it. So very bullish if gold can, and this is not going to happen today or tomorrow, but going forward, the bullish scenario would have it break above this downtrend line and then more importantly break above 130.05. That would be very long-term bullish in my opinion and open the door for a move up here to that 150-ish level in GLD. Where likewise if we have an impulsive solid break and weekly close below this trend line, and then you can see I have support here. There's some decent support around just below 115. I call it around 114.90. A solid weekly close below that would be bearish for gold. So that's gold at support. I don't, see any really screaming reason to buy here. I mentioned in the trading room recently that it is on watch, under consideration for an official long trade. I'm long gold right now. I think it's a way to diversify. As long as it holds its support level, I'll give it a little room there, especially my longer term accounts and the miners and all those. Let's look at the dollar. In fact, we'll just look at, keep this video relatively brief. My favorite trading proxy, or one of my charting proxies, is the euro US dollar pair, since the euro is, over nearly 2/3 of the dollar index. Um, Here it is. So we had a divergent low right here. You can see the bullish divergence, at least on the RSI, and a pretty well-defined support level. If I had to guess, see this PPO is down below. I like to use that signal line, the white line, the 9 EMA, as a trend indicator. When it's above zero, this dotted line, that's the trend is bullish, and when below, it's bearish. And that zero line often acts as resistance when tested from below. So we are moving there, and the PPO is looking like it's rolling down right now with this little move down. So we may get a rejection and another move back down here to the bottom of the trading range. Now, where that's important is gold is, at most points in time, inversely correlated to the dollar. So remember, this chart, euro versus US dollar, is the dollar upside down, if you will. So when this is moving down, it means the euro is falling against the dollar is going up. So that's what it is. I see a little more downside. Now, sometimes gold will hold on, and if the dollar is falling, or I'm sorry, rising, like I'm looking at here, I can see a little more downside, maybe another touch of this level. Maybe not, but I lean that way. But as long as gold holds that support, I'm okay. That's not a big move. And then more importantly, let's get away from this daily time frame. This is the bigger picture. This was a very powerful, I've talked about this for years, big, strong, very clean. I like this type of divergence with clean separation in the peaks. You can see on the RSI and the PPO down below. PPO's here, RSI here. Prices, or this pair, the euro US dollar pair, making a lower low with the indicators making higher lows. That is positive divergence on the weekly time frame. And more importantly, you had this very large, powerful basing pattern here. This was a multi-year. That was nearly 2 years, 2.5 years, or nearly three, 2.5 years or so of sideways basing action. And the euro broke out against the dollar, back tested once, and now it's coming to back testing that level again. So until unless, and we'll call it around the 115-ish level on the euro US dollar pair, until and unless that level gives way, that's support. So what happened? We had a breakout, a powerful move up, but that terminated in this bearish rising wedge pattern. You can see there. Oops, wrong drawing tool. Trying to clean things up here. Right here and here. So you had this trend line, divergent high, negative divergence, just like you had positive divergence, and it played out for a correction. Now, I will say that correction is so far played out for about the measured target. You take the widest part of a wedge, which I've done here, add that to where the wedge breaks down, so it's more than met its measured target. Doesn't mean it can't go lower, just that this pattern has now been satisfied, at least by the technical measurement, and so those divergences may have played out. And the PPO signal line maybe is a hair below the zero line, which also works as a trend indicator on the weekly time frame we're looking at here. And you can see the PPO is curling up. You see how we're starting to curl up? That means the momentum's turning up. If that can continue, we get a bullish crossover here, get this white line, the signal line back above that trend indicator, and get the euro dollar or euro US dollar pair moving away from that level, that would be bullish, and that would open a door up for a move here. What that means for gold and other dollar sensitive assets is euro rises, dollar falls. That would be a big move, big drop in the dollar, and that would almost certainly provide a tailwind for a trade, a long trade in gold. So there it is. That's my thoughts on gold. And now let's move on to oil because there's been a lot of interest in crude oil recently. Pointed out the other day that we had this divergent high up here in USO, and you can see that's played out with a bang. That was right over there. I was just before I left. Finished up vacation, made a post here, expecting this, and we got it with a bang yesterday. So far, that divergent high is now confirmed or about to be. What I mean by that is when we get that bearish crossover right here on the PPO, we have to put a lower low in on that indicator right there. So here's that divergence. It spans a while. It's big divergence, big divergent high. Probably showed through better on the weekly chart, but there it is. So from this point to this point, this was divergent high one right here. Boom, correction one. Push back up and made a second divergent high, a lot like the NASDAQ 100 is doing right now in the stock market. Still another divergent high, simply an extension of the previous divergences. And so what has to happen with oil, at least USO, see this gap right here? We had a big fat gap, and that's where we fell. This is gap support and trendline support. So that's where the USO crude oil ETN has hammered off today so far. Maybe we bounce a little bit, but I can tell you, regardless of where we go over the next few trading sessions, call it about 1470 or so, that's resistance. You zoom in there, you can see it. And we have this big red candle. If we get back above that red candle, that'd be pretty darn bullish, but I don't think so. I think maybe at most I see a pushback up to that 1470-ish level. Anything's possible, but ideally, if we can get a break below this trend line soon, break below that 1420-ish level that we found support on today and yesterday so far, get a bearish crossover here. I think USO is coming down here to about that $13 level. And from where we're at right now, that would be a drop of about another 9.8, almost 10% from where we're at today. So a lot of meat on the bone for oil. I need to keep this video streamlined. I'll have to do another update on the energy stocks. Somebody asked, they were looking forward for an update on the energy stocks. I had mentioned doing that, but let's just focus on the commodities themselves right now. And keep in mind, the energy sector, I'm talking XLE, XOP, all those components in there, will follow, give or take, they're going to follow where crude oil goes. So if you see a 10% drop in crude oil, I promise you're not going to see the energy stocks rallying 10%. Maybe they fall a little more, maybe they fall a little less, but more or less they're going to track crude oil. So let's move on from there. Gasoline, where these videos might come in useful, even if you're not trading any of these commodities. Let's say you run a business and you have a fleet of vehicles, and gas is a pretty big expense to you. Well, this chart can tell you, and you can hedge. I've mentioned that in the past. You own a business and you have a lot of fuel costs, you can go long or short UGA, which is the United States Gasoline Fund ETF. So this is a way, for example, if you want to hedge against rising prices, you go long this by X amount. You just have to do the math. If your expenses are, X amount a month, you just, do enough, do the math, and again, take enough position in this large enough position, and if prices go up, then any losses you have on your fuel costs will be offset by gains in this ETN or futures. Again, if you're sophisticated enough and comfortable enough with using futures, that's a more efficient way to go because you have leverage there. Either way, what I see in this one, I should add a line right here, right about there. I see a big gap right there. You can see that big gap down off the top. We had a divergent high there, gap down, went danced on this well-defined trend line. This is a large, an important trend line that comes all the way back here from June 2017. Broke it, back tested it for a while, failed, also failed right around the bottom of that gap as well, and then boom, a big impulsive red candle. So if you ask me, based on the fact this was a divergent high, followed by a trend line break, followed by a successful back test and rolling over, I think gasoline prices are headed lower from here. I think there's more downside. I don't want to give you targets right now because I really haven't studied the chart much, but I will say, let's just throw this one out there. I think that's a pretty likely target around 29.83 on this one. So we're talking in gas prices another 10.5%, which roughly aligns a little bit more, but roughly aligns with the crude oil targets. All right, let's now go through the rest of the commodities in no particular order. I have a watch list below. Just pull these up. Probably stick with the daily charts here. COWTF, this is the UBS livestock total return. ETN. I'm not crazy about this chart or my opinion, but you can see there's this pattern here. It's been moving up in this price channel, broke down recently, and it's back testing. So if anything else, PPO did get above the zero line recently. I can't take too much from this chart, but I can say this yellow line, which is around 2174 or so, was a key support level in the past, which was broken, briefly regained, and now we failed. So I can tell you this. One of the two, I would rather be short than long this one. Why? Because that yellow trend line, this was a failed breakout. Cal tried to regain that. It fell down below. We're also below that trend line. We're back testing after breaking down. So I think this one has another leg down from here. I think it's objective short if you have a stop not too far above that yellow line. But again, not one of my favorites. It won't be an official trade, but I figured I'd share my thoughts for those interested. JJCTF. This is the old JJC. A lot of these ETNs changed from 3-letter tickers to 5-letter tickers, so they added TF on old JJC. And I say that because if you want to pull old analysis on the site and you use the post by ticker drop down box, that's what you'll want to reference JJC. Maybe at some point I'll update all the symbols to mesh on the prior analysis with JJC and the other ones to mesh with this new symbol. But here it is. Copper's fallen off a cliff, and I wanted to jump actually out to a weekly chart on this to talk about that. For those of you who traded or invested for a while, going back years ago, we used to call copper Dr. Copper. It was the joke on Wall Street because copper had a lot of predictive value for the economy in the stock market. Copper prices rising, sometimes ahead of the stock market that was bullish. So in demand for copper, a lot of things, that a lot of building, of course, electricity, all that they use copper. So and when things slow down, copper again, it was really stripped away from that title in recent years. There was China sucked away so much copper when they were building years ago. It kind of skewed the predictive value of copper, if you will. But I still think it's worth noting, and I'm going to show you a chart in a second here. Now, just real quick, when I look at this chart, this yellow trend line was very important. It was a primary uptrend line. It was broken and back tested in this area here. And then we have another level that I was watching as well. Is this high here around 37.42. We had 1, 2, 3, 4 failed attempts to get through that level. And then on that fourth failure, very impulsive selling. In fact, we haven't seen selling this impulsive in copper in a long time. These lines are support levels. I'd probably have to tighten them up a little. I'll tell you what, right now, there's probably support a little bit below there, closer to 28. Maybe we go there, but this is a confluence of support. There were a lot of trades back here. I wouldn't short copper at this level, nor would I go long based on what I'm seeing. I just wanted to point that out, that is concerning to see such a slide in copper. Sure, it might have to do, and probably does have a lot to do with the trade wars, but let's look at one other chart. I want to show you something here. We look at a long-term chart of copper. I'm going to compare it to the stock market, the S&P 500. And let's get this out of the way here. So what you can see is in the past, copper has had a pretty high correlation with the stock market. In other words, one goes up. You can see the stock market's in white here. This is the S&P 500 in white. Both moving up around the same time, both going down around the same time. So see that high correlation. All of a sudden, you start to see this disconnect here. The stock market, since 2013 has been moving higher with its corrections, while copper for a while fell into 2016. Then the positive correlation returned again, right? You can see that, how they both were going up. Now all of a sudden, and this is, you can see from this weekly chart, we haven't seen a drop like this in copper since all the way back. Let's see, there were some warning signs here. Back here, we can see, let me study this chart for a second. Okay, back here you can see we had a big slide, but that coincided with that drop in 2011. But what stands out to me is right here. This is what I wanted to show you. You can see suddenly, the stock market was holding its own for a while there, going up, and copper started to fall, similar to the drop now. And the stock market kind of chugged along for a while, and then had a little shot across the bow correction, pushed back up while copper prices continued to fall. We had a little kickback rally, but they continue to fall. See right there, while the stock market climbed. And then boom, this was the biggest correction at the time in years right here. Those two back-to-back corrections, especially that second drop there, late 2015. And copper warned of that. There was a disconnect with copper prices falling sharply while the stock market ignored it. Um, just something to keep an eye on, guys. That's all. Let's move away from this one. Next one up is BALTF. That's the old symbol BAL. That's cotton ETN. And you can see here, nice trend line, actually price channel defined by this uptrend line, and more importantly, this lower trend line, which has a lot more reactions. It's a thinly traded ETN. That's why you have these choppy candles. They don't look, as normal as some other candles with the tails and shadows, all that good stuff. But it looks like it broke down here. It's just slightly above, but we had a divergent high. You can see the negative divergence at this high. So this correction, we've already dropped quite a bit. Cotton fell from the highs about 12.5%, and that was foreshadowed by this negative divergence. So as of now, and we just recently broke below, we're a hair above it, but again, this thing trades a little sloppy. I'd have to scrub the charts with the cotton futures, but that PPO trend indicator for the first time since all the way back here, we had a bearish cross here and it stayed bearish here. Told you that's a bear market or a bear trend. And every other point on here, when you can see when cotton was in an uptrend, like oh gosh, trying to grab an arrow tool, but you can see that the PPO signal line, that 90 MA, stayed above the zero line down below when the trends were bullish. So that's not looking so good for cotton. I don't have enough convictions to short it based on this chart, but I will take a look at the futures charts, and maybe add some of these back. Earlier in the year we were trading the commodities, and I wouldn't mind adding some of these back. And I still think they all, as a basket, not together. I like to select commodities, some bullish, some bearish. Makes sense in your portfolio, especially long-term accounts for diversification and asset allocation. So here's OILNF. This is another oil ETN. I already covered USO. They're going to mirror each other, virtually identical. Same story, divergent high right there, and it fell down to support. You can see that line. So also, just like USO, OILNF is that trend line support, and big divergences. So longer term, I'm bearish on this one. I think it comes down to at least that 71.21 level, possibly more. USO we already covered. I think I started with USO. CUT. Been bearish on the back a few months ago, and I maintain my bearish bias, bearish on the timber ETFs. That's CUT and WOOD, which we'll get to in a second. Again, these are not a direct play. Timber is not a actual commodity. It's not traded as a commodity on the exchanges. So what you have on these ETFs is I'm sorry. You have random length lumber prices. That's what you can trade, but not timber. The timber, these ETNs hold companies. These are forestry companies, logging companies, paper, things like that. So unlike every other ETN that I just covered so far, which actually invests in futures as the underlying investment for those ETNs, this one holds a basket of stocks, corporations, companies. So there it is. This one looks to be flagging. We had an impulsive move down there off the highs. That was a divergent high, by the way. This one's been diverging for a while. So we put in a divergent high. I just need to extend those lines right here. You can see I'm sloppy drawing, but that's it. So this was a divergent high right here. Negative divergence, and we had a pretty well-defined uptrend line. We broke down below it. That was impulsive selling. That's your flagpole. This is a bear flag, and that would be your measured target somewhere down around there, maybe a little bit higher. I just kind of rough estimate it, but I remain bearish on cut. And here, I'll show you wood real quick, since that's the other timber ETN. This one even has a better chart. This trend line goes back to early 2016, this yellow trend line on WOOD, very well defined. Let's zoom back to this 2-year daily chart, and you can see recently breakdown back test. That's about as objective as it gets. I was bearish this one up here on this trend line break, this minor trend line break. Same story. I just moved it a little bit. There it is. Breakdown, back test. So you either short on a breakdown and or add on a back test, or short there. And again, you have a second opportunity. Short breakdown, short on the back test, and this one needs to break now these recent lows right around 76.60, and if it does that, next stop is down here around 71.14. So I'll just try to quantify it for you. You're looking at a good, another 9% at least downside in WOD, and before all said and done, each of these are potential targets. So let's just say right now this is my preferred target zone. All right, so next one up, I'm going to skip aluminum. Wheat. Wheat is at support. There's support here around 612, that line. You can see reactions here. Let's mark those up for you real quick. You can see reactions there, reactions from below, reactions from above, reactions from above. So there it is. We had a divergent high here. This was a trade on the site. We hit this, I guess we hit this first and second target. We trade wheat on and off over the years quite a bit. But you can see we had at this point when the second target level was hit for maybe the second or third time, we had negative divergence. You can see down here, just like we had positive divergence at the lows. So this is it. Wash, rinse, repeat. Keep things simple. That's not an objective time to get long or stay long. It's an objective time to look to short. Wheat's come back down, but I think that divergence has certainly played out. Can't say whether there's more downside or not. I'll have to study the charts a little bit more, but I can tell you it's at support. So possibly an objective long entry here, but again, I'd like to study the charts a little further before considering that as an official trade. DBA, this is an agricultural ETF. We had a divergent low right here. That's a DL right there. That's what that stands for. Divergent low and a nice rally. It was a good for about 8% or so rally. Now we have another divergent low. It's sort of stretching this divergence. If we go much lower, this divergence line will be burned through on the PPO, but we still have divergence on the RSI below. I'd have to look at the individual components of DBA before really giving a strong opinion on that. But yeah, look for at least some type of bullish reverse candlestick reversal if you're interested in this one. I wouldn't short it at these levels. I think the risk reward, it's just not enough meat on the bone to the downside. But if we can take back this big red candle, maybe get above that level, that might be bullish. Soybeans, it looks like they're in free fall. They broke this trend line right here. We had an uptrend line which was broken and then just waterfall sell-off. Looks like a bullish PPO crossover in the works. So nothing else. I think this one's due for at least a counter trend rally. Oversold, maybe 5% or so pop there. But again, I'd have to study the charts a little further to make a case for a swing trade on that. But I certainly would, if I had to be long or short now, I'd probably be long. But again, I'm not. It's a crapshoot. I want to have a make a stronger case to enter that one. JJGB, that's a grain ETN. Looks like it's not trading much anymore. Foil, that's aluminum, lead. I don't have that chart marked up. Too thinly traded. UGA, this is one we already covered. Gasoline. That's natural gas. There's coal. This one's simple. I don't see any move or trade in it right now, but you can see in the past, the divergent high right here, correction. Divergent high here, correction. Divergent high here, correction. Divergent high, correction, trend line break, more downside, and then a divergent low finally in a rally. And where we're at now, I don't know. I don't have an opinion on this one, so we'll just move on. I'm not crazy about it. I think there's probably more downside in that one, just taking an eyeball on this chart, but really don't have a strong opinion. Corn, just like wheat, corn and wheat, they usually trade very similar, and they're also in that that grain ETN that holds corn, wheat, and soybeans, JJG. It used to be JJG, and they added a couple other letters to the end. But again, in free fall, very oversold. You can see the RSI, just like wheat. You can see the RSI is oversold. Last couple times we were oversold were good times to go long. Usually is. As well as a low-level bullish PPO crossover in the works. So this one looks good, for maybe a bounce trade here. But again, you want to really look at the intraday charts and look at the futures charts to confirm that. Otherwise, stocks don't have to go up or down. They can go sideways. So that's why I don't force a trade just because something's oversold. That doesn't make it a buy. You want to see a little more evidence in the charts. All right, so we're almost done here. UNG, of all the commodity ETNs, the natural gas ETNs do the worst job of tracking the underlying, which is our natural gas futures. So I will make mention that it looks like it's breaking below this trend line, but I'd have to, again, look at nat gas futures. I do not trade these ETNs. I prefer nat gas futures if I'm going to trade it. And if I'm going to use these as trade ideas on the site, any of these natural gas ETNs, I will confirm an entry with the charts of natural gas. JJGTF, there's that grain ETN I just mentioned a minute ago, holds corn, wheat, and soybeans. So therefore this chart looks identical to those. Therefore my thoughts are identical to what I already said on corn and wheat. JJOFF, this is the coffee ETN, looking pretty good here, potentially. Just hanging on to these divergences by a hair. There's still divergence. I'd like to also confirm that on the futures. burned through the divergence on the RSI. However, as you can see, those circles down there, it is overbought. In fact, this is about as deeply overbought as it's been since all the way back here, and that was good for a rally of, remember, coffee can move. That's one thing about this one, about 28% or so. That last time it was this oversold. We had an oversold reading here, not as oversold, but it was still good for a good rally. Looks like at least double digits. And recently we had a big green bullish candle right there. You can see that. Gave back a little. This one, probably minimal downside. Again, I want to look at the futures charts, but I like this. I'm interested in this. And I'm going to track this, and this might become an official trade if the futures charts confirm. All right, next up, NIB. That's Cocoa ETN. Looks like a swing trade here. I think they just ran our stops on that one by a 1 day and intraday hit, but that went on to play out as expected. T1 was right here, hit. T2 was down here, and that was hit. And it continued on to a very nice support level, and then bounced from there. You can see we had reactions here, a reaction here, reactions from above here, and that was that breakout right here. We came up to it and then had a big impulsive breakout, big green candle, and that's exactly where this one came back down to. And something I've noticed is it's maybe a case of the tail wagging and the dog. A lot of these ETNs, and gold's a good example. The ETNs are so popular, so much money flowing out of some of these ETNs, not all of them, but they can tend to influence the charts of the actual commodity they're tracking. Where it used to be that these ETNs were obscure, not many people trading, but if you have a lot of money flows and people buying on technical analysis based on these ETNs, buying and selling, well, the ETN company has to then buy and sell futures to meet the inflows and outflows, and that looks like what happens here. I mean, you have perfect tags to that level, and then we free fell right down to it, boom, and bounced off it. Now where we're at now, again, that was a former target level. You can see that's resistance. We stopped right at resistance. So my guess on this one, maybe another leg down because we're at resistance. This PPO is below the zero line. Looks like it's turning down, so maybe another thrust down, possibly a short entry there around 29.90 for a swing down to this level. Let me give you that level real quick. About 27 or so. All right, a couple more and we'll wrap this up. It's a long video, but covering a lot of things in here. Cane, this is a sugar ETN, positive divergence right here, potential, what I call potential divergence. Why? Because the momentum indicators are still pointed lower. They haven't turned back up yet. So that means we could continue to fall. However, if we do reverse soon with a bullish crossover here, those divergences will be confirmed, and we need to get by that 738, call it 740 level. That is resistance. It was support just recently broken. However, I like that because I think if we get above there, and I think we'll pop above there, and this will prove to be, this recent move down below it will prove to be or have been a bear trap. That break of support. So you'll have the shorts that shorted that cover, and I think it'd be a quick pop back up to 812 from where we're at right now to try to quantify it for you. If you wanted to take a shot here, let me have to move away from these lines, or I'd grab them, try to come in with the crosshairs just to the left of that, and then move up to 812. It tells me that's a 17% run up there. Yeah, almost a 17% gain to 812, and I see the possibility of a move up to 880. That'd be about a 26% run in cane, which is a sugar ETN. That's another sugar ETN, not traded much anymore. And then, of course, SGGFF is also another sugar ETN. And same story, divergent low, obviously. It's sugar ETN, it's just two different companies, so it's going to mirror each other. All right, guys, that's it. I think I went through them all. Long video, but there it is. And if you have any questions, feel free to drop me a line in the trading room. And like I said, I'll look to maybe add some of these as official trades, or maybe even unofficial trades with some price targets. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.